Welcome to my channel. I'm Scott, and I'm going to show you a simplified DCF model that's available for free on my Patreon page. But if you're not a member of my Patreon channel, just copy everything in this video into your own Excel file. This model is fairly similar to my DCF model. The reason I simplified it was to make it more user-friendly, but the differences are insignificant. You need to really understand the high level of the DCF. After we complete the model, at the end of the video, I'm going to show you different scenarios that could really influence the result of your DCF. The company we're going to look at is my favorite company, Facebook. And you can get all the information for free. You don't have to pay for anything. Pretty much everything comes from Yahoo Finance. All you have to do is input 7 numbers. So let's get the market cap. Let's go to Yahoo Finance, type in FB, and the market cap is 533.065 billion. Type in the entire number, 533.065, and then 6 zeros. All the numbers are in millions. So even though it looks like 533,000, it's actually 533 billion. Let's get the stock price. The stock price is 195.84. You can get the revenue growth from Yahoo Finance. If you click on analysis right here, and then you see revenue estimate, there are 51 analysts that estimate the revenue to be 132 billion in 2022. In 2023, the revenue estimate is 155 billion. To calculate the percentage growth, take 154.75 minus 132.28. Make sure that's in parentheses, and divide that by 132.28, and that comes out to 17%. The terminal value growth is the growth into perpetuity. I usually use around 2 to 2.5%. Let's use 2%. The reason you cannot put more than 2.5% is because on average, the US economy grows about 2 to 2.5% a year. If you go back the past 50 years, that's about the average inflation rate. So if you put 3% and the entire US economy grows at 2.5%, then at one point in the future, this company would be larger than the entire US economy, which obviously cannot happen. To get the WACC, you can use Finbox. So go to finbox.com, go into the search field, type in FB, then click on models, then scroll down to cost of capital, hit the view button, and then you can copy this box into your file. The WACC is the discount rate. The higher the WACC, the lower your result will be. The lower the WACC, the higher your result will be. So let's use an 8% to be conservative. Now we need the annual free cash flow. In Yahoo Finance, just go to Financials, then go to Cash Flow, and then free cash flow is down here. You want the most recent 12 months, which happens to be all of 2021. So that's 39 billion. And make sure you add 3 zeros. Now we need the annual revenue. Let's go to Yahoo Finance, go to the income statement, and the 2021 revenue is 117 billion. All the numbers are in thousands. That's why we have to add 3 zeros. Now we have our result. Our model calculated the next 4 years of free cash flows. It also calculated a terminal value. It discounted those numbers using the weighted average cost of capital. The sum of the free cash flows is the value of the company, 1.1 trillion. We divide that by the shares outstanding, 2.7 billion. Shares outstanding is a calculation. It's market cap divided by stock price. That means according to our model, the value of Facebook is $407 a share. It's trading at 196, so it's trading at a 52% discount. It's a buy according to the model. I'll show you how to calculate the free cash flows. You first have to calculate the future revenue. To calculate next year's revenue, it takes the annual revenue times 1 plus the revenue growth rate. Then to calculate the next year revenue, you take this 138 billion times 1 plus the annual growth rate. And you do the same thing for the next 2 years. To calculate the future free cash flows, you take the annual revenue times the free cash flow over revenue. Free cash flow over revenue is simply the annual free cash flow over the annual revenue. And you do that for 4 years. To calculate the terminal value, you take the last free cash flow annual estimate, that's 73 billion. You multiply that by 1 plus the terminal growth rate, the 2%, and divide that by the WACC minus the terminal growth rate. So 8% minus 2%. To calculate the discount factor, for year 1, it's 1 plus the WACC to the first power. For year 2, it's 1 plus the WACC to the second power. For year 3, it's 1 plus the WACC to the third power. And year 4 is 1 plus the WACC for the fourth power. And the discount factor for the terminal value is the same as the fourth year discount factor. To discount the future free cash flows, you take the free cash flow estimate, the $46 billion, divided by 1.08, and you do that for each year. If you do a DCF for a company that has stable revenue and free cash flow for the past few years, your result will be a lot more reliable than doing a DCF for a company that has really volatile numbers. It is possible you do a DCF for a company that has negative free cash flow. Let's just say, for example, Facebook invested a ton of money into their Meta platform and they had negative free cash flow in 2021. Let's put negative $2 billion. The free cash flow over revenue is negative 1.7%, so the future free cash flow is negative. This implies the value of the company is negative $57 billion, which doesn't make sense. In this situation, I may use Facebook's free cash flow from 2020 or 2019. If the company only reports negative free cash flow, then maybe look at similar companies, what their free cash flow over revenue is, and use that number. So if you were looking at a company that had negative free cash flow every year, and say you found a similar company that had 10% free cash flow over revenue, and you put 10% into your model, then this implies the company will have positive free cash flow every year. But you know they have negative every year. So maybe you would make the first and second year negative because you want your model to make as much sense as possible. The reason we do a terminal value, which is estimating all the free cash flows into the future after the fourth year, because it's pretty much impossible to estimate free cash flows for the next 20 or 30 years. Companies that have stable revenue and free cash flow for the past decade, you may only need to do a terminal value. But a startup company, maybe you want to estimate the next 7 or 8 years, because maybe you feel they'll have negative free cash flow for the next 5 years. And the purpose of the terminal value is to stabilize their growth. But if you're looking at a company and doing a lot of analysis, and you just don't see them ever having positive free cash flow, in that case, just don't invest in the stock or short it. Obviously, the DCF is only as good as the inputs, but just getting a baseline like we have right now will help you a lot, because then you can tinker with the variables. Maybe you feel 17% growth is unlikely. In the video I recently did on Facebook, I only had a 5% growth. Even with a low revenue growth, I still have the stock as undervalued. The weighted average cost of capital is the cost for the company to obtain financing through debt and equity. If it's a startup, it's going to cost them a lot of money to obtain financing, 14 or 15% interest on their debt. You may be thinking, how could a multi-million-dollar company have to pay so much interest on their debt? My mortgage is only 3% or 4%. Because a mortgage is a secured loan. It's secured by your house, an asset. When a company takes on debt, it's not secured by anything except the full faith that the company will pay back the debt. And if the company loses a lot of money year after year and their future growth prospects are questionable, they're going to have to pay a high interest rate to take on that debt. That's why most young companies issue stock and dilute to shareholders to get financing. It's definitely not a perfect science, but by doing the DCF, it helps you understand the company a lot better. No DCF is perfect. It's impossible to predict the future. The way I think about the DCF and about my videos is I'm trying to use the information I have available about the company, about the economy, about that industry, all the information I have available, and try to identify a stock that's undervalued. If it's a penny stock, the only way my DCF model will work is if I get lucky. If it's a stable company, then my DCF model is a lot more likely to hit my price target. But if you combine the DCF with your due diligence, it will give you a major leg up on a lot of other investors. You may do a DCF on a company and the model indicates a stock is a great buy. And then over the next month, the stock goes down 20%. But why did it go down 20%? If the entire market went down, then we know the reason. But if the market went up overall and that stock went down, then it could be a problem with the company, or it could be market sentiment, which nobody can control. If it's market sentiment, just a lot of people start talking negatively about the company, thinking they're going to go under, but you know it's a solid company. It just needs more time to develop. These are the types of scenarios you want to figure out. Initially, just do the inputs I mentioned. After you do a few dozen DCFs or a few thousand like me, then you could start altering these inputs, and before you know it, you're identifying undervalued stocks before others do. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.